Without proper retirement income planning, your Medicare premiums could increase by over 300%. In this video, I'm going to show you why and how you can avoid that problem. So first off, I want to look at the costs that are associated with Medicare that really are the same regardless of income. And when we go on Medicare, there are really only two ways in which we're going to use our Medicare coverage. One way is to stay in what we refer to as the original Medicare A and B system. A is the inpatient side of Medicare, B is the outpatient side, as well as all doctor-related services. When we do A and B, A has a zero premium, and the reason for that is because throughout our working years, we are paying into Medicare taxes. And as we fund Medicare, Medicare says as long as we have paid into Medicare tax system for at least 10 years, which is called 40 quarters, then there is no premium for Medicare A. It's premium free. In fact, only 1% ever has to pay for Medicare A. 99% have the 40 quarters or can get it from a spouse or an ex-spouse. All right, now Part B does have a premium, and we call this the base premium. This is where we start, and it's $164.90 a month. And if someone's on Social Security, that $164.90 comes out of their Social Security check. If they're not, they can set up a bank draft with the government until they take Social Security, or they can be billed on a quarterly basis. All right? And that's, again, the base premium. Now, in addition to that, if we stay in original Medicare A and B because there are gaps, financial gaps that Medicare doesn't cover, most people in this system then get some type of a supplemental plan. I'm not going to go into all those because that's really not our issue today, but supplemental plans have a separate premium. Now, most people today are getting either a G plan or an N plan. All right, I'll just use the G as our example. So when we have a supplemental plan, basically what we're doing is taking the gaps and transferring the liability of those gaps to an insurance company, and therefore we have to pay them a premium to take that financial liability from us. So if I do the G plan, that insurance company takes all the gaps except one a year, and that's called the B deductible. That's $226 for the whole year, and after that we have 100% coverage. So we're a nationwide company. We write in all 50 states. And so I'm just going to give you an average G premium. Truly, the state you live in, this could be lower, it could be higher, but the average right now for a G plan is right at $125 a month. Okay, now when we have original Medicare with a supplemental plan, we also have to add a Part D plan for our prescription drugs that we self-administer. Some plans are as low as $7, some are higher than that. The average right now is right at $30, okay, $30. And so that's, again, that's the average. Yours could be a little bit more or less. And so as we add these together, these are going to be fixed cost. And so let's do so. So we've got 90 cents here, we've got 9, we have 5, we have 1, and we have 3. So in this scenario, we have $319.90 in fixed cost premium. We paid Medicare, our supplemental plan, of course, to get rid of the gaps, and our drug plan. All right, and so in this system, we pretty much have eliminated most of the risk medically, for sure, because we only have to meet a small deductible. Here, of course, we have some copays and different things, but pretty much we paid premium to get rid of the risk. And this is what about half of all people choose a Medicare supplemental plan. Now, the other people that don't go with the supplemental plan will enroll in Medicare A and B, and again, the cost is the same. A, as long as you have 40 quarters, is free, or your spouse does, and B has $164.90. And so when people choose this other option, these plans are called C plans, also called replacement plans or advantage plans. And so this is a private health insurance company that's replacing Medicare. Over here, Medicare actually pays bills and as part of the claim process. Over here, a private health insurance company does everything. Medicare just pays them a flat fee on your behalf. And so you're enrolled in A and B to have the C plan, and normally Advantage plans in most areas are going to have some type of a zero premium plan. Zero premium, and the reason for that, instead of paying a premium, what I do with these plans is I pay copays and co-insurance until I hit a max out of pocket for the year. But the point is, as we look at these systems, here I pay a premium and I'm pretty well done. Here I don't have a premium, but I pay as I go until I hit the max for the year. And then also with Advantage plans, they include a prescription drug plan. Again, these are called Part D plans, right? Here we had a premium. Over here, they include it. It's an embedded plan. Now, the difference is here, they pick the plan. Here, you pick the plan. And so when someone goes Advantage, we got to make sure we have good drug coverage. Here, we pick our own drug plan based upon the meds in the pharmacy that we want to go to. So my whole point is this. These are the costs that are associated with Medicare and really has nothing at all to do with income, okay? You don't pay more for your supplemental plan because of high income. You just don't do that. So what is affected, though, by our income would be this, okay? So that's what's the same. And now let's talk about what is different, what could be different based upon your income, and that's this. Your Medicare Part B could be higher, and your drug plan could have an additional amount tied to it as well. Same over here. Even though the C plan has 0 premium, you're going to have to pay for your Part B. So that could be a higher premium here. And our drug plan also could have something added to it. And the things that we add to these B and D, those are called IRMAs. It stands for an income-related monthly adjusted amount, all right? And so here's what happens. In both of these systems, when I enroll in Medicare, if I'm going to start my Medicare in 2023, the government's going to look back at my 2021, what is called modified adjusted gross income. If I'm going to start in 2024, I'm on Medicare, they're going to look at my 2022 modified adjusted gross income. And so it's our modified adjusted gross income that determines how much we actually pay for Part B, either way we go, and if we're going to have an additional surcharge or what's called an IRMA that's attached to our drug plan, again, either way that we go. And so what we have is we have thresholds. And so the thresholds, and these are modified adjusted gross income thresholds, and I'll show you the formula in just a minute. But I want to show you if you're a single filer and you make as a single filer $97,000 or less, then this amount is correct. But if you make above $97,000, then there's going to be something added to that. That's the surcharge or the thing called the IRMA. Same thing over here. If you have an Advantage plan, they're going to add to your Part B premium that surcharge. Now, if you're a married couple and you file, notice this, a joint return, not married filing separately, it's different. And that number is $194,000 or less. Again, no surcharge. They don't add anything to this at all. It's just exactly the premium. Same thing over here, no surcharge. But if I'm going to be above that 194 as a couple, now they're going to add to my D plan and they're going to add to my B premium as well. All right. And so next I'm going to teach you about the modified adjusted gross income because that's something that we need to be conscious of as we do our retirement planning.
Hey, just real quickly, if you're finding this video to be helpful, you can like, comment, and subscribe. And if you do so, that'll let YouTube know that this is helpful information and they'll send it out to others who also need to learn about Medicare.
All right, so let's talk in detail this formula that will determine whether we're going to have those surcharges, which are called IRMAs. And again, remember our thresholds. Single, $97,000 or less, I do not have an IRMA. A couple, married filing jointly, $194,000 or less in my modified adjusted gross income. Again, I don't have an IRMA. Above those numbers, we're going to have IRMAs. All right, and so here's the formula. The first thing we have to do is we have to look at our gross income. Gross income. And what this means, this would be all of your income at work. This would be your self-employment income. This would be at your job, your W-2 income. This also includes interest. This includes dividends. Okay. Really anything that you would be reporting because it is now taxable. This also includes, and very important for this, this would be capital gains. If someone has those, that's going to be part of this. So on it goes. But most importantly for our conversation is this is also all of our IRA or our 401k or 403b, all those distributions. Okay. That's also counted as income when we take those distributions. So again, our gross income, anything that's going to be taxable. Then what they do is they subtract what they call adjustments to income. These adjustments to income are going to come off. So it's minus that. All righty. Now, that would be things such as any student loan interest, any type of like an HSA contribution, any contributions to your IRA or your 401k. Some of your self-employment taxes could be an adjustment. There's a whole list of things on the 1040 that shows you how you can actually decrease this total income. So once all those allowable adjustments are made, now we come up with which is called our adjusted gross income. All right, now again, we're not yet to our modified adjusted gross, because that's what we're looking for to determine whether we have IRMAs or not. But here now we're at adjusted gross. So what we're going to do with this now, they're going to add to that AGI our tax-exempt interest. Tax-exempt interest. Now, this is typically interest that is earned on some U.S. savings bonds that were used for educational purposes. Also, interest that you earn from municipal bonds. Typically, municipal bonds they're federal exempt for taxes. You may have to pay state. Some states yes, some states no. But the point is, we still report that number on our return if it's tax-exempt interest, municipal bond return. And so we put those two together, and then that becomes our modified adjusted gross income. Now, there's a couple different IRS forms. It could be the 1040 or the 1040A or 1040EZ, but normally, like on the 1040, this is going to be line 11, and this over here is going to be line 2A. Okay, on your form. Put the two together, and that becomes our modified adjusted gross income. And then that modified adjusted gross income is put to a table. It's this income table that we're going to use to determine whether or not we're going to have those IRMAs. So let me grab my table and let me read some of these numbers off to you. Okay, for those people then that stay below the thresholds, remember the Medicare A was 0. B this year was $164.90. So as long as I'm below the threshold, that's all I pay for my B. I do not have any kind of an IRMA. But if I'm going to be above 97 or the 194, now I have IRMA. So let me show you the schedule. I'm just going to use this a married filing joint. You can take these numbers if you're single and just very simply cut it in half. All right? So we go through these 5 different levels of IRMAs. Let me write those down for you. So we know from 194 to 246, we have an IRMA of right at $78. Okay, that's a $78 IRMA. Now, that IRMA, I totaled the two together, so part of that 78 is part of the B IRMA, which actually in this example is $65.90, and then $12.20 is the D IRMA, the Part D IRMA. So that's a total of right at $78. So I've combined the two together. So now, at $246,000 to $306,000, my total IRMA, B and D combined, is going to be $196. And again, these are monthly amounts. And then from 306 to 366, I have an IRMA B and D of $315. And again, I've rounded these numbers up or down just to keep it simple for the video. And then at 366 to 749, we have an IRMA of $432, B and D combined, and then anything $750,000 or above, we have an IRMA of $470, okay? And so keep in mind now, these are added to the $164.90. So everyone pays that. That's the base amount. But as our income's increased, depending upon where we're going to be, they're going to add these amounts then to our Part B and our Part D, totaling these particular numbers here. So you can see you're talking substantially more money that people have to pay based upon whatever their modified adjusted gross income is. And remember, if I'm on Medicare in 2023, they'll look at MAGI in 2021, 2024. They'll look back at 2022. These numbers are adjusted on an annual basis. Hey, if you're finding this video helpful, I want to invite you to go right up here and actually click on a link that will allow you to watch what I call the Medicare Essentials Workshop. It's a workshop that I did that really is going to show you everything you need to know about Medicare from A to Z, how to enroll, when to enroll, and the plan options for you. So go to that link and check it out. So if it's possible, we want to, through proper planning, try to stay under those IRMA thresholds. Again, for single person, if we can, below 97,000, 194 for a couple, because above that, we have to start paying the IRMAs. So how can we manage that? How can we plan for that? Well, remember, all this is going to be based upon your modified adjusted gross income. And what was in that AGI? All of your taxable income. Now, if you are already retired, that could typically be pension. It could be a portion of your Social Security income. But most certainly, if you have saved all your life, you put money into 401ks, taken money into 403bs possibly. Maybe you have IRAs, possibly SEP IRAs, simple IRAs, all those kinds of things. That money went into savings, into some type of a deferred account. You put the money in there pre-tax, you got to deduct that, and so those monies have been growing. As those accounts are invested in things that give you a decent return, hopefully they've grown a substantial amount of money. But you have not paid taxes on it yet. Now it's time, the government says, for you to start taking those at a certain time. And so we call these required minimum distributions. You cannot let that money set in there and just grow and grow and grow with no tax consequence, unless, of course, it's a Roth IRA. All right, so that which has not been taxed is now going to have to be taxed. And they require that you take a certain amount out. And this is an amount that's going to grow for sure over time. But the whole point is this: I have to start taking out. Now, here's the rules. If you're born after January 1st, 1951, you have to start taking your RMDs, which are going to go into your income amount, at age 73. If you're born before that, you had to start taking them at 72. It used to be 70.5, and they changed that here in the last couple of years. But the point is, we have to take that money out of our account. And some of you are going to have sizable RMDs. That's going to affect your modified adjusted gross income. And so what you want to do is you don't want to have to pull out any more than is necessary. You want to be legal with the government, because if you're short any on an RMD, there's actually a 50% tax penalty. And so you don't want that. But again, you don't want to have to take any more out than you really need to, because all that money is going into that modified adjusted gross income number. So we do everything we can through proper planning to minimize that, so we don't have to pay surcharges. Now again, if your accounts are so large and it's going to push you into these thresholds, then obviously you know now why it is you're going to have to pay an additional amount for your Medicare Part B and your Medicare Part D. And I share all this with you because I meet a lot of people who are not aware of this, and they don't do the proper planning, and it really comes back to bite them. And we don't want that to happen to you. So be sure you're aware of the way it works and do everything you can to get proper retirement income planning.